Hello and welcome back to the channel, where we uncover the fascinating world of hard-to-borrow stocks and the mechanics behind potential short squeezes. Today, we're diving deep into a very specific situation that's captured our attention on our hard-to-borrow screener, AZI Internet Technology Global Limited, trading under the ticker AZI. We'll break down exactly why this stock is popping up on our radar and what the numbers mean for anyone looking to understand these complex dynamics. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show AZI logo/chart. Let's start with a quick introduction to AZI, or AZI Internet Technology Global Limited. This company operates in the consumer cyclical sector, specifically within auto and truck dealerships, providing automotive products and services in China through both online and offline channels. With a current market cap of just $5.07 million, it's a micro-cap player. Looking at its recent price action, AZI is down 15.45% to date, but it's flat over the last 5 days, showing 0.0% change. However, if you zoom out to the last 30 days, AZI has seen an impressive gain of 40.91%. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? At its core, it refers to the scarcity of shares available for short selling. When you want to short a stock, you need to borrow shares from someone else, typically a brokerage firm, and then sell them. Later, you buy those shares back to return them to the lender. The fee you pay for borrowing these shares is called the cost to borrow, or CTB. This fee is usually expressed as an annualized percentage. The higher the demand to short a stock and the fewer shares available to lend, the higher that CTB fee becomes. It can even exceed 100% annualized, meaning it would cost you more than the stock's value just to hold a short position for a year. That's a powerful signal. Why this stock is hard to borrow right now. Highlight CTB numbers on screen. Now let's talk about AZI. This stock appeared on our hard-to-borrow screener with some truly remarkable figures. Its annualized cost-to-borrow fee is a staggering 634.0%. That's not a typo. To put that in perspective, a fee of 6% is often considered high, so 634% indicates extreme scarcity and demand from short sellers. What's more, this CTB has seen significant momentum, jumping plus 54 percentage points over just the last 5 trading days. This isn't a static situation. The cost to short AZI is rapidly escalating. Currently, there are only about 20,000 shares available to borrow against an estimated float of 4.4 million shares. When the available supply is so tiny compared to the total tradable shares, any significant demand to short or cover can have a disproportionate impact. Squeeze mechanics explained. So, how does all this tie into a potential short squeeze? Imagine short sellers have borrowed AZI shares at a certain price, betting it will go down. If the stock starts to rise instead, and the cost to borrow those shares skyrockets as it has with AZI, short sellers face a dilemma. Their losses accumulate as the stock price goes up, and their holding costs increase daily due to the high CTB. At some point, this pressure can become unbearable. Short sellers are then forced to cover their positions by buying back the borrowed shares in the open market. This buying pressure, especially from multiple short sellers trying to exit simultaneously, can rapidly drive the stock price even higher, creating a self-reinforcing loop known as a short squeeze. Our internal composite squeeze score for AZI currently sits at 49.9 out of 100, reflecting these underlying pressures. However, it's critical to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will eventually fall, and they are willing to pay these exorbitant fees to stay short. Dilution risk check. Jotax, no dilution risk found. When assessing short squeeze potential, checking for dilution risk is paramount. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can flood the market with supply, often depressing the stock price and making it much harder for a short squeeze to gain traction, even if the cost to borrow is high. For AZI, we checked for recent dilutive SEC filings like S-1s, S-3s, or 424BS in the last 90 days, and we found no such filings. Additionally, there has been no recent reverse split for AZI in our look-back window, which can also impact share structure. This absence of recent dilutive events means that, from a structural standpoint, the float hasn't recently been artificially inflated by the company itself. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show AZI chart again, highlight volume. For AZI and any hard-to-borrow stock, several key indicators are worth monitoring. Keep a close eye on the cost-to-borrow rate. Is it continuing to climb, or is it starting to ease? What about the number of shares available to borrow? A further decrease would heighten the pressure. Volume is also crucial. Today, AZI saw 291,500 shares traded. Compare that to its 30-day average volume of 12,660,333 shares. This translates to an effective Xerox relative volume, meaning very little trading activity today compared to its average. While low volume can sometimes lead to sharp moves, consistent buying volume is typically needed to initiate and sustain a squeeze. Price action, especially on higher volume days, will be a key signal to watch in the coming days and weeks. AZI Internet Technology Global Limited AZI presents a compelling case study in the dynamics of hard-to-borrow stocks. With an incredibly high and escalating cost to borrow, a minuscule number of shares available to short, and no recent dilution, the underlying mechanics for potential short squeeze pressure are certainly present. Remember, these are complex situations, and high CTB is an indicator, not a guarantee. We'll continue to track AZI and other stocks on our screener. If you found this explanation helpful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments what stocks you'd like us to break down next. Thanks for watching, and we'll see you in the next video.